So we are moving to the plenary session number 3, which is which information on intangible do investors and markets consume for their decision making. And so we are going to have the point of view of users, as a terminology used in the EU, but I like to use the term doers. We do. We are in the action, if I may say. So to discuss that question, I'm pleased to welcome two very experienced doers of the financial market, and they are already there in person, and thank you for their participation. So I'm pleased to introduce François Perrin from Groupe Bruxelles Lambert and Jean-Baptiste Rouphael from ODDO BHF. So I'm going to present both our speakers. So Dr. François Perrin is head of ESG at Groupe Bruxelles Lambert, based in Brussels. François began his ESG career in advisory and corporate positions with KPMG in Paris in 1995, and Suez in Paris and Brussels in 1999. He moved into investment management positions in 2004, pioneering sustainable and responsible investment solutions for Lambert in Geneva, BNP Paribas Fortis in Frankfurt, BNP Paribas Investment Partners Asia and its capital in Hong Kong, and back to Europe in September 2020 to join Groupe Bruxelles Lambert. He brings decades, 25 years, 30 years of experience in ESG integration across multiple asset classes and continents. Dr. François Perrin graduated from École Normale Supérieure Cachan, holds a PhD in finance on sustainable and responsible investment from Grenoble University, a postgraduate diploma in finance from EM Lyon, and a master's degree in economics from Paris Panthéon-Sorbonne. And I move to Jean-Baptiste Rouphael, who is head of sustainability research at ODDO BHF Securities, and he has been in that position since September 2018, where his team produced research report on sustainability matters, and he helps, and I can confirm that because we are a very happy client. He helps investors to build responsible investment strategy. And before that, he worked for PwC as a consultant, senior consultant on sustainability between 2014 and 2018, but also had other professional experience, including working for a corporate. It's always important when you are an investor to also have the experience of having worked for a corporate, the Lafarge SA company. And he's graduated from HEC Paris. So that was for the presentation of our two speakers. And before letting them the floor, I'd like to remind three short realities from the point of the investor point of view when we think about intangibles. The reality number one, and thank you, we had just before the slide from Mr. Futoshi Nasuno showing the importance of intangibles when you look at the S&P 500 in the United States. What you can notice is that intangibles are more and more important for investors, whatever brands, data, intellectual property, clients, supply chains. And so they are more and more part of the value creation in the long term, whatever you think, single or double materiality. And it has already been said, intangibles already today in Europe, in the US, etc., represent the majority of market values, financial market values of corporates, and the majority of their investments. I mean data, software, IT, training. So that's the reality number one. The reality number two is that traditional accounting, formalized by Italians in the 15th century, 600 years ago, is less and less useful to assess the present and, above all, future financial performances of corporates and other organizations. Reality number three, also being already addressed, the poor, unfortunately, for us users and doers, the poor degree of reporting when we think about intangibles, whatever we consider human capital, relational capital, or organizational structural capital. Good news, and we had very important and positive and encouragement inputs from people from Japan and Europe. We see encouraging improvement regarding especially human capital disclosure in Europe, Japan, and we know that there are interesting discussions in the US at SEC level. I'm going to have questions now to our two speakers, and of course we will have some minutes for Q&A. So now, oh no, don't want to destroy the technical part of our event. Up. And I sit in the middle between two great people. I'm going to start with Jean-Baptiste with the first question, with a very concrete one. Could you, in some words, give us one example of a sector and a corporate where you, as an investor, you consider it is key as an investor to look at intangibles?
Yeah, I think that the luxury sector actually is a very good example, because this is typically one sector where there is an intangible asset that drives long-term value creation. And here I'm referring to the brand, the strength of the brand, and specifically one of its components, which is reputation. Reputation has more and more importance in the luxury industry. Why? Because luxury customers are more and more consideration for environmental, social, ethical issues, and also luxury customers are very active in social media, and I'm sure you're aware that on social media, the reputation of a company can be broken very quickly. And here, I'd like to give you an example of a company which is Hermès, because Hermès has the reputation to have an excellent management of its brand reputation. And I have a very interesting conversation with my colleague in charge of covering Hermès, and he told me that actually in its valuation model, Hermès has a lower beta than its peers. So it means that financial market considers that Hermès is a less risky asset than its peers. So financial markets value Hermès' ability to manage one of its key intangible assets, which is actually its brand reputation management.
Thank you. François, a comment on this first question, an example of a sector of corporate where you as an investor, you think it was great to look at intangibles?
Thanks, Jean-Philippe. Good morning. Maybe I will just introduce very quickly our ESG approach at GBL. It's important to have that in mind to consider the answer. We are a small team. We manage a portfolio of 20 billion. And whenever we will be looking at an investment opportunity, there will be a lengthy due diligence phase. It can be up to 6 months for us on one investment case with a team of 15 investment professionals. So we have time to dig, and we have time to dig extremely deep. So that's maybe the big difference between traditional asset management practices. We can use that time to literally take each and every stone on our way and be comfortable with that. And on the list that you mentioned earlier in your introduction, the reality 1 point, being brands, data, intellectual property, clients, supply chain, if we think that it matters for our ability to extract value from an investment, we will spend time, we will spend money, and to really have 100, 200, 300 pages report, extremely lengthy conference call with the management of the company we are targeting, and potentially even site visits. Recently, we were involved in a due diligence on for a pharma company leveraging on a byproduct from animal production. So supply chain was a critical issue. And we typically went up to visiting a number of potential suppliers in the supply chain to have our own assessment of ESG practices there. And it's an interesting question for me because one thing is to say you've got risk in the supply chain. The next question is, are these risks capable to disrupt your business? Yes and no. And in that case, honestly, even if the supply chain would have been massively impacted by a number of ESG controversies, most likely the supply of the byproduct that we were targeting would not have been disrupted. So if you go back to your P&L, stability of supply, stability of your cost of goods sold would have been stable. We would have continued to make money, generating cash. Problem was more the next level, how these ESG controversies in the supply chain in a new disclosure regime would potentially put a flashlight on GBL owning that type of asset and having to deal with, I would say, ESG controversies in one of our investments via the supply chain. And for us, one of the key, in fact, negatives that came out from this assessment was not so much a disruption of the supply chain, was the potential impact at our level in terms of reputation. So we tend to see a much shorter way now between the potential controversy and the final owner of the investment.
Thank you, François. I'm going to continue to let you the floor at the beginning of this session because I think a lot of people will be very interested by the developments you do dealing with artificial intelligence and how you see today the role of artificial intelligence in your day-to-day business.
When we were preparing the conference and thinking about intangible, the first thing that for me came to mind was AI. Not that AI is not the hot topic of the day, but it's really trying to make something out of that and trying to put a number of things into perspective when we think about valuation, what is captured by current financial accounting reporting, and what is really the true value of a company, considering that whatever happened in the past is already in the share price. So it's really a question of what type of tool and what type of reporting or questioning do we have to put in place to ensure that we capture value in the future. And what I'm referring to when I'm thinking about AI, it's not ChatGPT. The 3.5 version, you can download it on your mobile phone. It's nice to have. You can look smart in a meeting, type the question, you'll get a straight answer. Not even ChatGPT 4. I'm talking about quantum AI. So quantum AI, just a quick introductory word, and to put things into perspective. When the US launched Apollo to the moon, they were using a nice big computer, more or less, size of that building. iPhone 6 was already 30,000 times faster in terms of computation power. But iPhone 6 was a 2010 product. In 2023, after 13 years of massive investment by the semiconductor industry, and what I'm thinking about, it's TSMC. When we talk about intangible, look at TSMC, Taiwan Semiconductor Manufacturing Company. They are the one driving whatever you think the future will be in terms of technology. And when you look at TSMC, intangibles is basically what is driving share price, book value, whatever. TSMC managed to put from 2010, the iPhone 6 to the iPhone 15. 2010, they were spending 6 billion capex a year. 2023, they are spending 30 billion a year. This year, they will continue to deliver 10 billion free cash flow, so it's not that they are spending that for fun. They are making money out of that. They deliver constantly over the last 20 years, 20% return on capital employed. The true value of TSMC, the intangible part of their business, is this ability to put a lot of capex at work and to extract value from it. Value being computation power. And back to Apollo. Now, the iPhone 15, in terms of computation power versus Apollo, is 3 million times faster. And what AI, quantum AI is about, you take one chips that you can find in an iPhone 15, and you put 5,000 chips like that in series, all together, working for a day. Being that you are working with something that is 15 billion times faster than Apollo. And what you do with that type of quantum AI, the question is not getting access to your data in your phone. You generate synthetic data. And then you bring that back to your board. And you start really to question, what do you do? And what type of improvement you can have. Improvement being what type of super efficiency you can target. When we move through efficiency, the search for efficiency in fixed asset investment in the 70s, we were thinking about automation. And this is where the great company, the like of Toyota, really managed to capture something that was new, also part of their pricing on the market. But when we think about the revolution that AI will bring in the future, and that's pure intangible value today in a company, that's basically this ability to get access to quantum AI and to put that at work. How? Testing new molecules. Instead of going for 8, 10, 12 years of development, testing a molecule, realizing after 5 years that, oh no, it's not working. Take 5,000 chips, work with them for half a day, and you will have all the combination possible. 1 day of development. Return on capital employed and return on the spending you can do in research and development will be massively increased. Cybersecurity, testing of your data, testing of your risk model in a bank. Application for that type of computation power are massive and are definitively shaping or reshaping the future of a number of industries. So what today we really need to question when we are interacting with board is how do you perceive, beyond the typical use case of AI, the disruption in your business? What is the IP and how will your own IP be challenged in the future by that type of technology? Who can completely disrupt your industry? Are you trained to understand that type of challenges? Assessing that type of question and having straight and clear answer from the different board director you can sit in is today something that is really challenging. But this is basically where the value will be created. So when you step back and you think about, as ESG investor or as ESG aware investor, how you integrate that in your investment process, how is the board reacting to that? Do you have an ESG policy addressing AI threat, but also opportunities? And thinking about the social consequences of the automatization process in fixed asset investment in the 70s, in the 80s, in a number of developed economies, how will AI impact the social tissue of our own economies? How do we have to upskill a number of skills in the workforce? All that type of things should be today part of any ESG policy, both on the opportunity side, but also on the threat side. And that's something that we should really, as investors, be supporting the company to implement. So that's where we will be able to capture the intangible aspect of most of the business.
Thank you, François. And of course, this is what you said is completely transversal for all investors and all organizations and whatever we invest in small, mid, large companies in all countries. Thank you. Jean-Baptiste, we already had some input regarding regulations and intangibles. Here we represent European investors. What would we say regarding CSRD and intangibles?
Yeah, it's true that the CSRD has been heavily discussed before. My view is that the CSRD can help identify and better identify intangible and partly deal with some intangible. One example is that as part of the double materiality assessment, intangibles are fully integrated and need to be taken into consideration. Not going to read the text, but if you want to have a look, it's on page 24. Second point is that the CSRD sets standardized definition for indicators that are very useful to measure intangible asset. And here I'm thinking of employees turnover. As of today, it's very complicated to compare employees turnover from one company to another. And thanks to the CSRD, hopefully we could manage this. And last, the CSRD sets disclosure requirements on intangible themes. So for example, there is a disclosure requirements dedicated to business ethics and corporate culture. So of course, it will be only on qualitative information, but I think that it will be pretty useful. So all in all, I think we should not be naive. The CSRD will not allow us to value all the intangible assets, but at least it will be easier for us as analysts, as investors, to better deal with these intangible assets.
Thank you. François, a word, if you want, on CSRD and more generally European regulation?
Okay. 25 years ago, I did my PhD on CSR disclosure. And I used to be head of sustainability reporting for utilities, largest utilities company in Europe. At that time, I had a chance to join, via the WBCSD, the writing of the Global Reporting Initiative. We had one mandate, multi-stakeholder, multi-industry. And we delivered the standard. 3 years later, in 2002, we released it in Johannesburg. What we realized in 2005 is that GRI was leading to carpet bombing in terms of information. You communicate whatever to whoever, no targeted communication. Lesson learned, SAS became. As a portfolio manager, you kind of appreciate having a small set of key KPIs where you have a clear link. And I've been on both sides. I've been PM, I've been a CIO, I've been a sustainability analyst, and today I have investment partners who, honestly, they are not the most aware ESG people on earth, but they are willing to understand. So when I have to engage with that type of hardcore financial individuals, go for SASB. They will understand why it's important, because for them, they can visualize the link between a sustainability issue and the impact on the investment. So CSRD did not learn about the mistake from the past, going back to a multi-stakeholder approach, going back to a multi-industry. And what we will have in the future, it's again a massive carpet bombing of information. Think about how we, portfolio managers, are using this information to make investment decisions. Do you think that we need 1,200 data points to make an informed investment decision? Don't think so. We need 5, we need 10 key critical indicators per industry. The rest is literature. Sorry to be harsh on that. And the best example of the misalignment between what financial market really needs and what the regulators think they can deliver or they should deliver for a number of reasons is the taxonomy. As a portfolio manager, you will never, ever make a decision based on taxonomy. Taxonomy is a fixed framework looking at an industry with a framework from the past driven by lobby activity. That's the content of the taxonomy. As a financial investor, you invest for the future. Give me a single industry who's never been disrupted by innovation. I was talking about AI. And think about the ability of the taxonomy to capture that. So invest with the taxonomy, take the highway, drive looking at the rear window, betting that there will never be a curve in front of you, and face your client a couple of years later.
Thank you, François, for this short but powerful wake-up call, if I may say. You said that you focus on a couple of KPIs. Do you have some example to give us, whatever turnover of employees that is already been said, or client satisfaction, such as Net Promoter Score or cyber security investment? I mean, can you give us some examples?
Okay. The one that is working the most is ESG controversies in terms of severity and in terms of recurrence. To put it in another way, a dirty company run by dirty guys will remain a dirty company run by a dirty guy. Even if you change the management, culture will not change overnight. So you can run backtest, long, short, go long on the nice guys, short on the bad guys. Globally, Europe, China, emerging market, it works 100% of the time. So when you look at a company, the first question is, how often are you exposed to controversies? And is it something that is leading to severe consequences? The second one is the quality and track record of the management. What is the quality of the management? At GBL, we've got 13 portfolio positions. We changed 9 chairman or CEO over the last 4 years. That's the impact we have. If we think that the management is not capable to deliver, you change it. It's maybe harsh, but it's really a question of alignment between the strategy and the type of guys that will be in charge of delivering it. Incentive scheme. Make sure that STIP, LTIP are aligned with your strategy and the ability of the management to deliver. Can include ESG, intangible, name it the way you want. It's really a question of scope, coverage, and the vesting period. GDPR, cybersecurity, and value chain are also some of the critical aspects. So when you use that, and you have relatively fair comfort in this different area, you can start to look seriously at investing.
Thank you. Jean-Baptiste, do you want to add something on KPIs, or we can move to another point?
Yeah, just on a controversy, I'm very curious to know how do you measure it, because are you using MSCI controversy, or are you doing your own homework? Because we are aware that there are a lot of bias if we are looking at MSCI controversy, which is today becoming kind of a standard, and notably bias regarding the size of a company, because of course the bigger company is, the highest is its exposure to controversy. So how do you deal with this?
It really depends the type of investment you are running. If you are running large universe, MSCI can be a source, but the question is really the clustering approach you have on that, and not taking one controversy, I would say, at a time. It's are you exposed to a lot, are you exposed a little, or are you not exposed? And MSCI can be wrong, but in terms of big picture and ability to have cluster, it's working well. The way we invest, when I was saying that we can spend 6 months, we've got time to spend hours and due deal on a single name to basically to go through a number of media sourcing. We've got also AI tool capturing that. So it's it gives us a sense of the level of exposure. And it's really high exposure, moderate exposure, or limited exposure. One thing that is interesting, and I came across that type of case recently, it's no exposure at all. It tells you also something that it's wrong. You cannot be not exposed to controversies.
Thank you. We already raised the point that there are some key intangibles, such as corporate culture or quality of management, difficult to measure, but material. I mean, that will not be the same thing with innovation capacity or client satisfaction, where you have more access to metrics. But when you have to address pure qualitative intangibles, such as corporate culture or quality of management, do you consider that the investor should lose interest in these intangibles or not?
Not at all. I mean, on the contrary, I think that some intangible assets that are very difficult to measure should be monitored very closely. And here I would like to talk about avoided emissions. So avoided emission by a company to its clients thanks to its product. And here I'm going to give you one example, Saint-Gobain. Saint-Gobain manufactures insulation products, and Saint-Gobain allows its clients to save 1.3 billion tons of CO2 over its life cycle. So this is a huge amount, and this is an amount that it's not included in Saint-Gobain financial statement, and it is not even included in Saint-Gobain carbon inventory. Does it mean that we should not consider this intangible asset? No, I think that everyone is aware that there is a huge hidden value here, but the problem is that no one is able to assess it as of today. Even the CEO of Saint-Gobain was asked about the valuation of this hidden value, and he was not able to answer. Still, I consider that as analysts, as investors, it's our duty to keep on monitor these kind of indicators, because everyone knows, again, that there is kind of very strong hidden value here.
Thank you. I noticed that we are in the final 5 minutes of this session, so I'm going to ask the last question to François, because your company and you have the experience of investing at the same time in liquid, but also on non-liquid asset classes such as private equity. Do you consider the access of intangible data, the access to data is similar or not?
When you deal with private assets, at first glance, you are in a much worse position, because a private asset today who has never been owned by a fund or a publicly listed company will most likely not report a single ESG data. No exposure, if no very specific client requirement, forget about getting access to ESG data. But the beauty of it is, because you start from a blank page, you can really quickly transform that business radically. And as part of our investment process, when we spend 6 months looking at a private asset, we start to collect, in fact, much more information than whatever you can find from MSCI, from Sustainalytics. We have dedicated consultants working on each and every potential area. It can be value chain, it can be controversies, it can be compliance. So the day you decide to move in fact, you have much more information. And the first thing that we will do, typically, if there is no climate data, we will put a carbon footprint analysis as part of the 100-day plan. You can get access to geolocalization data. You can get access to your own set of data, and in fact, you are the one designing the data you need to run the asset. So in fact, 6 months after the investment, you are in a better position in a private asset than in a listed asset where regulation, history of the company, systems are most of the time fixed or much slower to evolve. In a private asset, you will be much more agile. And the type of KPI you can really look at and leverage on, it makes more sense.
Thank you, François. Before I let the floor for 1 or 2 questions, just please notice that we represent family businesses, Edmond, Rothschild, ODDO, and Bruxelles, Lambert. It's not a surprise that all 3 were ready to embark in intangibles. Why? Simply because all shareholders are long-term oriented. Their view is the next generation. And it's a plus for us just to do the job in the interest of the company, but above all in the interest of our clients, to deliver sustainability, but also financial performance. Think about long term, and that's I wanted to give you this this point of view. Questions? Yeah, please. Please, a micro for the lady, please.
It's okay, thank you. So I'm Clémence Garcia from Gakuin University in Tokyo, and I have a very simple question. When you have some destruction of value, so potentially positive things that turn bad, how do you deal with these situations? Do you mix all intangibles together and compute things like residual positive values, or do you separate different elements to identify if some can be dealt separately from the remaining value? So how do you deal with these situations?
I think that the example of Hermes that I was given at the beginning, I think that, for example, if there is a deterioration of the reputation of Hermes because of controversy regarding its brand, my colleague in charge of covering Hermes in its own DCF model, he will adjust the beta factor. So maybe this is one example. I mean, in terms of cost of capital adjustment.
François?
We used to be invested in a very large known European companies. I will not tell which one. We were in the board. We were the largest shareholder. We were on the board. We were in the audit committee. We were in the nomination remuneration committee. We had no control. So, number of things happen, impacted our reputation. You stay invested. You try to basically re-rein on the management. You change the management. Things related to the culture of the company are not changing. You stay invested. At some point, you start to realize that the lack of grab you have on the management, the lack of grab you have on the strategy, the lack of grab that you have on a number of key decisions related also to financial leverage, and finally the lack of grab you have on ESG related to number of commitments that were not discussed at the board. These four things, management, strategic decision, financial leverage, and ESG are the key four pillars of any investment thesis in our company. So once you realize that this is weak, you exit.
Of course, we can do this because
it takes time.
We are sell-side financial analysts, so we have different levels to act. And
thank you. We have to stop right now to keep the tempo. We have now a break for a quick coffee or tea coffee. Thank you to our two speakers. Thank you for the contribution.